we are in a weird economy, man. We are in a weird market. We have people talking about a stock market crash, a real estate crash, a cryptocurrency crash. Oh my God, XYZ stock asset is booming. You had the real estate crash, and then you had the financial sector ultimately just get so close to being annihilated because banks got greedy.
How do we prepare for a market crash?
Well, the first thing you gotta do is when markets crash, you wanna have cash. Because if you have cash, then you can buy assets on sale. Market crashes make more millionaires than any other time. You see more millionaires come out of recessions than any other time because that is when you can come in, if you have cash and you are financially educated, you can come in, buy assets for pennies on the dollar, and then just ride the market up. When the 2008 crash happened, you saw so many more real estate millionaires come up than any other time. You saw a lot of people lose everything in the 2008 crash because they were over leveraged in real estate. They were buying properties they shouldn't. They were taking on risky loans when they couldn't afford it. And then when the bubble burst, it gave opportunity for people who were now ready and educated to go and do something. I mean, that's when I started buying real estate. I started buying real estate after the 2008 crash. And you know, we're in Michigan, and we have Ford, GM, Chrysler as our primary economic drivers.
That's right.
And when the 2008 crash happened, GM went bankrupt, Chrysler went bankrupt, and Ford was on the verge of bankruptcy. So you had the biggest employers in our state pretty much almost completely wiped out. And you saw massive amounts of foreclosures. I mean, you had properties here selling in some instances for 95% off. The first investment property that I ever bought was a small condo, about 1,000 square feet. And prior to the 2008 crash, similar condos were selling for between the ranges of $120,000 to $150,000.
Wow.
So they were selling between $120,000 and $150,000. But I was able to come in and buy it for $8,000 cash. That wasn't the down payment. That was the actual price of the condo, $8,000. That means unheard of in this market. It's a good area, right next to a bunch of shopping, in a good school district. And I bought the property, put a little bit of money to renovate it, and I rented it out for for $600 a month. And I was just getting started in real estate, so I made a ton of mistakes. But that was the type of market that we saw. And I mean, there was just so many different types of distressed deals for people who were financially prepared, people who were financially educated. Now, I wasn't very financially educated, and I didn't have a ton of money with me. I was in college. I was running my event planning business, and I was making decent money, but I was funneling that money into assets because I started reading books about money, and every book said that every wealthy person invests in real estate. I had no idea what the heck that meant. I didn't have any real estate investors in my family. I told my dad, I want to invest in real estate. He was like, you're stupid, go study. But I was like, this is something that I wanted to do. Anytime I was actually studying for my MCAT, the medical college admission test, and anytime I took a break when I was studying, I went onto the news, Yahoo Finance, and it said that real estate prices hit rock bottom. And to me, an $8,000 condo was normal because I hadn't known anything else. Yeah. That's all that I knew. And so, I started buying. I started buying as many different things as I could because I was like, well, I'm making a little bit of passive income. I made a ton of mistakes, but anytime I made some money, I was buying properties. And as I started to grow, I started to buy bigger. And you saw all different types of distressed deals. You saw physically distressed, which was where properties were physically beat up. And, I got to meet a whole bunch of different contractors. So we were doing a lot of stuff with renovations. I got to be pretty good with that. And then we also saw financially distressed, which was, there was a property that I bought. It was an apartment complex, 20 units in a great area, growing area, probably worth $1 million. We were able to come in and I bought it for just over $400,000. Mm-hmm. Why? Because it was vacant. Or mainly vacant. The people that were there were not paying rent and needed a little bit of work. And the owner was so overly leveraged. It's interesting because at that time, there was this big thing on zero down real estate. Buy real estate with no money down. Mm-hmm. And the owner of the property was actually one of those real estate gurus. And he used to teach people how to buy properties with no money down, how you can create cash flow with these properties. And as I started to go into this deal, I looked up the owner, saw that he was this guru teaching this, and I went onto his website, and he like had this course or whatever, and the homepage of his website was him in front of this property, this 20-unit property, which now he was foreclosing on, which was being foreclosed on, that I was about to buy for 40 cents on the dollar. But he was talking about how he bought this property for like 1.1 million with very little money out of his pocket, and how it's making him rich. And then that was the property that, you know, the banks forced him to sell because he had so much leverage, didn't know how to manage the property, and then we were able to come in and buy it for pennies on the dollar.
Wow.
So market crashes are a part of our economic cycle. You see booms, you see busts. There are times where the market goes up, and there's times where the market goes down.
Yeah.
Now, 2008 was an exception. I mean, it wasn't things going down. It wasn't like just a cliff. It just went poof. Like it was pretty wild what we saw in 2008.
Yeah.
Now that I look back and kind of really understand it. But market crashes happen. They happen in stocks, they happen in real estate, they happen in cryptocurrency. You see it happen across all asset classes. And the mistake that people make is either A, they assume that no market will ever crash, or B, they try to just perfectly wait for the crash. Now, let's start with A. You assume that no crash is ever going to happen. Well, this is where people get greedy. People
Right.
They get emotional. They invest on emotion rather than financials. We talk about all the time. When you invest on emotions, not financials, now what you're doing is when the market goes up, your friends start to get rich. They start making all this money, and you hear about your friends making these trades or investments, and they're doubling their money. And you're like, holy moly, I need to get in on that. I want to make some money too. So now you're buying way up here. And what happens is you get the media effect. And what the media effect is as the market is going up, that's when the media comes out and they start reporting on it. They say, oh my God, XYZ stock asset is booming. 19-year-olds are becoming millionaires. People are getting rich. Don't miss out on this opportunity. Buy now.
Yeah.
What that does now, it creates this new frenzy. So people now start coming in, they start buying more. And this pushes this asset class to above normal, and it just keeps going, and that can be fueled with the help of easy debt, cheap leverage, because if people have access to debt and leverage and easy access to it, then that just makes the bubble bigger, because now people can put more than what they're willing to lose. They put in their own money, they put in margin from the broker, they might go into credit card debt, they might refinance their home to now take this cash and put it into this thing which looks like is making everybody rich. It's a guaranteed way to get rich quick. And people, you know, as much as we want to talk about it, people have this innate want to get rich quick.
Right.
It's like wanting to lose weight fast. Who wants to lose weight slowly? But if you want to actually lose weight sustainably, you got to put in the work. If you want to actually build wealth, you got to put in the work. You know, there's always going to be people who are greedy. They want to get rich without putting in the work. And so that's what happens, right? That fuels the bubble even bigger. And then you get to this point where people are looking at this investment, they're looking at the fundamentals of their investment, and they're saying, holy moly, this asset is worth a lot more than it probably should be worth. Maybe we should take some profits off of the table. So then you have some of your fundamental investors that are now cashing out a little bit because they've seen gains which are a little bit rich, and so now they sell. And so that's when you start to see the market turn a little bit. Once you see the market turn, the people who were buying really high start to panic, and they say, oh no, maybe I should sell. Maybe I need to start selling. And then, you start to see it go down. And that's when the media comes in and they say, this thing is on its way down. The bubble has burst.
Yeah.
Get out while you can. Now what happens? You sell. And now your fundamental investors come back and they say, holy cow, this asset should be worth a whole lot more money, but it's selling for way cheaper. Let me come in and buy. And so that's what creates these boom and bust cycles. It's people that get excited, they get emotional, they get greedy, they want to buy. You can leverage that up with cheap and easy debt, which allows it to go even higher. And then eventually it gets too high. It gets, this might be your baseline of where it should be, but it will go above that baseline because of debt and emotion, right?
Right.
And so then once it starts to turn down, then it will go below baseline because, again, debt and emotion. When people start selling with debt, now not only do they lose that $100 that they put in, they lost the other $100 from the stock brokerage, which causes it to go down even more, causes the bubble to go down, causes a whole bunch of other issues. People panic, people get scared. The media is now talking about how the whole economy is about to implode, the world is going to end. People get scared, so they start cashing out. And that's what causes it to go down, and this is where now the money is made. The money is made when you buy. And so now the smart investors come out and they say, this looks like a good opportunity for me, a good opportunity for me. So let me come in and buy. So then you kind of ride it back up. So these type of booms and busts happen. And so for the people that always like to say it's not going to happen, you end up getting burned, because then when you see it happen, you're on the losing side. And it's okay. I mean, to go down, it's just understanding it. That way you can ride it back up, assuming you have a good investment. And so the people that say, oh, it's not going to happen, or I don't think it's going to happen, they're the ones that get the most surprise, and they're the ones that sell at the bottom.
Right.
Then you have the people that say, I'm just going to wait for the crash to happen. Look, right now, we are in a weird economy, man. We are in a weird market. We have people talking about a stock market crash, a real estate crash, a cryptocurrency crash. Sure, all these things are possible, and they will all happen, but nobody knows when.
Right.
It can happen in 6 months or 6 years or 16 years. Like, it's impossible to predict when.
Yeah.
Now, there are real issues in our economy right now. Yes. There are real issues in each asset class. Yes. And, you should always have some cash ready to invest. That way you can take advantage of opportunities. But, you can never predict when a crash is going to happen or how big it's going to be.
Yeah. Nobody
could have predicted the 2020 pandemic crash and economic shutdown. Like, we were in the office before that. We were doing a marketing campaign, and on that Monday, I was like, a lot of things are going on with this pandemic. Let's just take a couple of weeks off. You guys just work from home, and we'll figure it out.
Yeah.
It took a year and a half before we started to come back into the office like normal. Nobody could have predicted that. Right. I had no idea what was going to happen. I mean, I stopped buying real estate. I had no idea what was happening. It was weird. It was scary. And so you cannot predict what is going to happen. You cannot try to time the market. And on top of that, it's impossible to predict now because of all, what I like to call the X factor. Government regulations and other outside factors which can manipulate the market. I mean, You would have expected that when 2020 happened, you would have saw a massive stock market crash, which did happen, but the crash to last much longer. We saw the biggest recession since the Great Depression, yet this recession only lasted 2 months. Why? Because the Fed stimulated our way out of it. I don't think anybody could have predicted that. I mean, yeah, maybe you would say the Fed, that they would print money if we see a crash. Yeah, I think everybody would say that. But to the extent that we saw, the trillions of dollars that went into the market, the unlimited quantitative easing, the amounts of bailouts that went out, no, I don't think anybody could have predicted that. I could have never saw that happening.
And you bring up kind of a good point there too, because you mentioned all these kind of problems with the economy and things like that. But if kind of the Federal Reserve and all these other kind of places, if they just continue to pump money into the economy, why would anything ever crash?
Yeah, and that's where things get scary, because now we're not just talking about markets, because you have each asset class, right? You got real estate, you got stocks, you got cryptocurrency, which are, you can kind of look at in their own individual bubble. Like, I love real estate and I love the stock market. I also love cryptocurrency, and I love talking about them, right? But the thing that's scary is now if we take a step back and we don't just look at each individual asset class, we look at the economy and the dollar. So, like, for example, with real estate, what caused the 2008 real estate crash? Well, one, you had all the ninja loans, no income, no job, no asset loans that were going out. You had subprime mortgages, meaning if you had a 500 credit score, don't worry, you can get you a mortgage. And the way it worked was you had literally 0% down payment mortgages for people who could not qualify for a loan, even if you didn't have a job and you had no assets to your name. So you have no job, you have no assets, you got no cash in the bank. You go to the bank and say, I want to buy this $300,000 home. They'll say, okay, how much money do you earn? I don't really earn any money. What assets do you have? I don't really have any assets. Okay, here, sign the paperwork. And if you close by this Friday, we'll even give you a free TV. There were commercials on TV saying if you can close and buy a home, you don't even need any money down. A bank will give you 100% loan. Sometimes you even saw more than 100% loans. Where if a home is worth $100,000, a bank would give you $105,000. That would help cover all of your extra closing fees. So banks are giving you 100% loans. You didn't need to show any assets, and then they would give you incentives like a free TV. That way you can close quickly. So you obviously had some risky people. You had some risky loans being made. And then you had the growth of variable interest rate mortgages. Variable interest rate mortgages mean that, hey, you can get a mortgage. Right now it's going to cost you $500 a month. In 3 years, it's going to go up to $1,500 a month. But banks didn't like to tell you that part. They would just focus on, hey, you can get this mansion, this big home for $500 a month. So people said, all right, cool, let me buy that home. And then 3 years go by, interest rates go up. And now your payments go from $500 to $1,500 to $1,800, and now you cannot make your payments anymore. You were already paycheck to paycheck. So what do? The bank says, or they told you before, you can refinance, no problem, or you can just sell your home. You'll have equity. Home prices only go up, just like the stock market only go up. Just like the stock market only goes up, because stonks only go up. And so you have this type of euphoria, and that's when things started to go down. And so now you owned a home. You had no equity in your home because home prices went down a little bit. And now you cannot afford your monthly payments. So what do? You say, hey, banker, you told me I could refinance. And the banker says, oh, well, you have no equity, so I can't refinance you. How about you try to sell? And they look at you and they say, sell? If I sell, I have to bring $20,000 to the closing table. I don't got $20,000. So now the banker's stuck, the homeowner's stuck, and you as the homeowner are now sitting on a, quote, asset, which is underwater. You can't afford the payments. It's a money hole. It's not an asset. It's a money pit now.
Right.
And then that's when things start to go down, because then that's when banks start to foreclose on you. And this bubble right there was the issue. Then that bubble became 100x bigger because you had the real estate crash, and then you had the financial sector ultimately just get so close to being annihilated because banks got greedy. They said, oh, wow, homes only go up in value, so we can lend you money. Sure, they started lending money, but then they said, how do we leverage up these bets? So then they started taking these loans, which were already risky, which were already subprime, which were already with no assets, no down payment, no collateral. They would take these loans, chop them up, create new securities, new assets, and then sell them. And they would sell them again and again and again and again and again and again. And then they would go out and create insurance and buy insurance out against these investments, because then the insurance companies said, we want to get in on the fun. You banks keep taking up all this, keep taking all of our money. So how about you give us some money too? So then the insurance company started creating insurance. They started insuring these bad investments. And so now when home prices started to go down, it wasn't just within the housing market. It was the entire financial sector. Now Wall Street was on the verge of collapse because now home prices started to go down, which was bad for the housing market. But then you had the financial sector almost collapse because now all these loans, these derivatives upon derivatives upon derivatives, just, it's like dominoes, falling over, which made this bubble much, much, much bigger. And that's when the bailouts came out. And you had the banks that were too big to fail, the insurance companies which were holding your pension, which were holding your retirement money, which were holding your life insurance on the brink of collapse. Why? Because they were insuring these bad investments, because they wanted to get rich too. And so now the government says, oh my God, what do? We encouraged everybody to be a homeowner. We told everybody to go out and buy a home because homeownership is obviously the only way that you can become wealthy.
It's the American dream.
Yeah, you got to own a home. Which we saw what the real cost of that is when you go out and try to live the American dream when you can't afford it. And now the government says, we got to do something. We got to save the big banks. We got to save the insurance companies. And they start printing money. Where does this money come from? Well, the United States government is not a for-profit entity. They are an entity which gets their money from you and me, taxpayers, tax dollars. The harder you work, the more taxes you pay, right? Mm-hmm. So now the government makes their money through taxes, which they then redistribute in the form of infrastructure, in the form of paying teachers, in the form of just doing a whole bunch of different things. Well, the government doesn't make enough money through taxes to pay their bills as it is. That's why the government is drowning in debt. We have a national debt crisis. And so now when they want to start bailing out these banks, not only are they taking your tax dollars to pay out these banks to make sure they have money to buy their bad assets because they made risky loans, but then they said, we are going to print money. Trillions of dollars. Now in 2008, it was nowhere near what we saw in 2020, but it was still a big chunk of money. It was historically the largest bailout that we've ever seen. And they started bailing out the banks. They started bailing out the insurance companies. They tried to get private mergers and buyouts to happen, but we saw an insane amount of money being printed. And so that made people feel okay. I mean, obviously some people were very angry, but the real thing is now that causes what? Inflation. Money gets printed, which means the United States is now into more debt. And this money goes out to these big corporations, these big banks, these insurance companies. And so now who pays the price? Well, you think, the government pays the price. Well, where do you think the government gets their money? It's through you and it's through me, right, through tax dollars. And then the average person gets screwed over again through inflation. Because now when you go to the store and you buy your groceries, it's going to cost you 25% more than it did before.
Wow. Because
more money keeps getting printed. More money, this money comes from somewhere. Money is supposed to be a representation of value. Mm-hmm. Gold is a real representation of value because it takes time, effort, and labor to mine an ounce of gold. It is a representation of value. Our dollars are supposed to be a representation of value, but the representation doesn't come from a physical asset because our dollars are not backed by gold. In 1971, President Richard Nixon took our dollar off of the gold standard, which means that now our dollars are not backed by gold. It's backed by a promise that the United States government is going to support the dollar. So the United States government says that your $100 can buy you something.
Right.
That's the only reason why people accept it.
Right.
And if you look at, the real representation of value, it costs 12 cents to print a $100 bill. So when we talk about representations of value, your $100 bill has value because the United States government is in power.
Right.
And it is the strongest government in the world. We have the world's reserve currency. We have the strongest economy in the world. But if that gets challenged, if the United States government gets challenged as the world's superpower, if our economy gets challenged as the world's strongest economy, now we have problems. Because then our dollar is going to be challenged as the world reserves currency. And if that happens, now all of a sudden, people are working for this money, right? These dollars, and they're going to say, wait, what is this dollar actually worth? This is really risky. You need to pay me more dollars. And that's when people start asking for more money, and that's when you start to see real inflation because people start to realize that their money is fake.
Yeah.
They start to realize that their money that they're working hard to earn is fake. It's not real money, it's just paper. And that's when you start to see more economic issues. So when you talk about concerns, yeah, we can look at things in a bubble, right? We look at the real estate market. We can look at it as a bubble. We can look at the stock market in its own little bubble. We can understand valuations. Like right now, we have companies with very high valuations. We have companies making growing revenues, growing profits. Why? Because of inflation, the price of the products are higher, so people are having to pay more money. So, we don't know if they're actually selling more products or if just the cost of the products are higher because of the inflation. They're making more money. And there's a lot of dollars in our circulation right now, which is causing people to now go out and buy. Same with the cryptocurrency market. People are losing their trust in the Federal Reserve Bank and the government. I don't blame them. Some people are trying to move into cryptocurrency, which is the people's movement of money. That's what cryptocurrency is. It's from the bottom up, not from the top down. We are getting rid of the Federal Reserve Bank. We're getting rid of these central authorities to control our money, and people are controlling money. That's what cryptocurrency is all about. And then you have the technology behind blockchain and all that. But this is where now, what do? You got to get educated, man. You have to get educated because then this is where people say, we need to convert our dollars to assets. We need to go and buy things. We need to buy assets. Yes, you do. But you do not want to chase assets. You don't want to just blindly throw your money into things. You don't want to blindly listen to a random guy on YouTube, right? I mean, you gotta be educated. Right. And so when we talk about the education, you got to learn. And, you got to learn by doing. got to be willing to make mistakes. You are going to lose money. You have to be okay with that. There's going to be times where you lose money. You have to understand asset cycles. You have to understand how to value your investments. I mean, this is one of the reasons where, we talk about in the stock market, the question everybody asks when it comes to investing their money in the stock market is, what stock should I buy? But that is the worst question that you can ask if you want to know how to invest your money in the stock market, because what's a good stock for you might not be a good stock for me, and vice versa, because you have different goals, you have a different outlook, and you have a different risk strategy, risk tolerance, right? And so if you want to see growth, you want to see higher appreciation, if you're 25 years old and you want to see that potential growth, then you should not be investing the same way that a 45-year-old does who wants to just see cash flow.
Right.
Or for a 65-year-old who just wants to see the preservation of their money. There's different goals which come with different strategies, and you need to know kind of what it is that you want to do. And based off of that, you need to know how to research companies, right? And so, people talk about investing for cash flow, which is good. I love cash flow. That's why I love investing in real estate. But you got to understand that in stocks, what does that mean? It means that a company like McDonald's has a whole bunch of profit, and instead of taking this cash and investing it back into their company to grow faster, they're just paying it out to you. Now, this is good for you because now you get your cash right now. But in terms of future growth, that means that McDonald's doesn't have the same future growth potential as a small startup does, who doesn't have a profit, because they're investing every dollar that they earn and more through debt and other investments to grow as big as possible, as fast as possible, because they're trying to acquire more market share. So this is what financial education is. You need to be educated about what your investments are. That's why we created Stock Market Insiders. And the whole idea behind that is now you can learn from a real coach who is walking you through different stock market lessons every single week. You have group coaching session every single week where you learn how to invest your money into these stocks. You learn how to value companies. You learn how to read fundamental analysis. You learn how to analyze companies on a fundamental level. Right. It's not for traders. This is for people who want to actually invest in companies for the long term. But this is for people who want to now understand how to read cash flow statements and profit and loss statements and understand how to value companies. So every week you get a group coaching session that way you can learn a lesson, and then you can apply what's going on in the market right now to your lesson, because all these lessons are live. Then you get access to your exclusive community of investors. We have a private Discord group for Stock Market Insiders. And even if you're a complete beginner, we have a course that you get for free when you sign up for Stock Market Insiders that walks you through the different lessons that you need to know about the stock market. So you get the class, you get the weekly coaching, you get the community, and then you get all the previous recordings. And this is a super affordable program. It costs less than the cost of dinner for two people. And you get access to all of that, to invest in your financial education. And if you still aren't believing in the idea, just try it out for free. We got a free 10-day trial. You can just try it out. You can go to the coaching classes. You can watch the previous recordings. You can go through the entire class. You can ask your questions in the Discord. You can ask your questions to the coaches, and then you can decide if it's worth your money or not. And so this is what financial education is all about. I mean, one of the things that we're trying to do here at Minority Mindset is make financial education accessible and make it real. You're not learning from people who are just teachers. You're learning from people that actually do what they teach. I mean, our coaches here are people that have been investing for years. These are people who have gotten great returns and have real money to show their success. And we're talking about hundreds of thousands, if not millions of dollars in the market. So, if you want to try out Stock Market Insiders, I'll put a link in the description below. But this is where financial education is so important. That way you can start making the right decisions with your money and understand what's going on. And this gets to the question of, okay, so what do I do? If the market's going to crash, do I keep my money in cash, or do I go out and invest my money? And it's a dilemma, because if you just keep your money in cash, well, now your money is being eaten away by inflation for who knows how long. But if you go in and just invest your money all right now, well, then you could be buying at the peak. And if the market crashes, now you don't have any cash to go out and invest. Right. And this is a hard answer. And there's nothing like right. Because we don't know when the market's going to crash. But what you can do, again, is be educated.
Exactly. You got to prepare. I think what you were saying before about, kind of the 2008 crash that happened, there was a lot of things that led up to that point. You mentioned a lot of things with the housing market and banks and things like that, and how that kind of trickled down, led to economic stimulus and things like that. But kind of moving into what happened over the last year or so, nobody could have predicted that. That was totally off the wall. So I think that kind of really puzzles a lot of people, and they have the hardest time understanding that. How do they actually, are there ways that they can prepare? Are you saying just, kind of get in ahead of it, or, how do they prepare?
So, I mean, again, it's that, what do you do with your money right now?
Right.
And I can't tell you what to do, because that gets me in financial trouble, gets me in legal trouble. But what I can do is talk about what I do. Crashes happen when people run out of money, when people are fully invested, when there's no more buyers at the table. That's when prices start to come down. And so as long as investors have cash to invest, that means there's more buyers out there, which can continue to push asset prices up. So what you want to do now is, or actually not what you want to do, what I do is I invest my money in two different ways. I have passive strategies and I have an active strategy. My passive strategy, this happens when the market's up, down, sideways. It does not matter. I have money going into ETFs in the stock market that gives me exposure into the stock market because I believe in the American economy. I have money going into cryptocurrency because I don't trust the Federal Reserve Bank. This is happening, my stock market passive investing happens every week. Every Wednesday, money gets withdrawn from my account and it goes into these ETFs. In cryptocurrency, I have daily investments that are happening, daily buys, dollar cost averaging into certain cryptocurrencies that I like. And then I also am passively buying gold. I buy gold every month, physical gold, not ETFs, real gold, because gold is a representation of value. And you can buy gold, silver, it doesn't really matter. So this is something that's happening all the time. Whether the market's up, down, doesn't matter. This is what I'm doing. Then I also have money that I use for my active investments, to buy real estate, to invest in startups, to put money into cryptocurrency, whatever it is, even in stocks. So this is money that's now, when I have cash and I find a deal, I'm going to invest this money into it. This is where now I'm being extra picky with my money.
Right.
I'm being very picky. When I'm looking for real estate deals, if it does not fit my investment criteria, I don't want to buy it now. We were in Austin. Properties in Austin were selling for 1.5 cap. What that means is, you buy a $1 million property, it's gonna pay you $10,000 or $15,000 a year in profit for $1 million investment. It's not that much. And the reason why they're so low is because these investors, the sellers, are saying, don't value our property based off of how much rent is making today or how much profit is making today. Value this asset based off of how much profit is making next year, the year after that, and the year after that, with 5 to 10% annual rent increases. I don't like doing that. That's speculation. Because what happens? What happens if rent doesn't go up? What happens if the economy slows down and you can't do that? Now I'm paying for next year and the futures prices today when I have no idea what's going to happen in the future.
Yeah, you're right.
So I don't do that. I buy based off of what it can generate today, and that leaves me a cushion. So if the economy slows down, I got room to lower rents if we need to. Same in the stock market. Hey, when I'm investing in companies, I'm being picky, man. You got to be pickier than ever. Don't just go in and start chasing. Don't chase. Learn. Educate yourself. Find something that's undervalued that you believe in for the long term. And then even if you do see a market crash, just keep analyzing. Because if it's a company that you believe in, then you just want to own it for the long term. You don't want to panic and sell. But again, that's the financial education. Same with cryptocurrency. Look, cryptocurrency, you're going to see wild swings up and down. It is not uncommon to see a 30% price movement up or down. So you have to be willing to accept that and understand it and know what it is that you want to invest in. I mean, we could see a 2001 style .com crash in the cryptocurrency market, which could also trickle down into other asset classes. And so when that happens, or if that happens, you would see cryptocurrencies and technologies get wiped out. But again, education. There are, we talk about earning interest on cryptocurrencies, which is great. But there are some investments, quote unquote investments out there in the cryptocurrency market, which pay unreasonably high interest rates. There are some investments out there that are paying 7,000-8,000% a year interest.
Wow.
And these are public right now. Why? Because they're highly risky and they will probably go bust. and some people are trying to play that game where, all right, let me put my money in, hope that I can double my money, triple my money, and then pull out. But it's a risky gambling game. I don't like gambling. So you got to, again, be smart and just know that if you're making investments, don't chase the hype. Chase the value and buy based off of that, and don't chase. And that way, if things go down, now, you have cash that you can use to now go in and buy.
Yeah. And so what you're basically saying is know what to do with your money today. That's how you prepare for a crash.
You got to know what you want to do with your money today and tomorrow. Mm-hmm. You have to know. You have to be prepared. You got to know that a crash is going to happen. And when the crash happens, you're going to buy, because the majority of people are going to run and get scared. That is the best time for you to buy. And you also need to know what to do with your money today in case a crash does not happen tomorrow, because you don't want your dollars to be eaten away by inflation. So you have to know both, and you have to be able to understand and do both. You can't just wait for it, and you cannot just do it today.
And when people are looking at that, what do we really consider kind of like a crash? Like what
a crash is a 20% price drop or more. Under 20% is considered a correction. So if the stock market falls 15%, it's a correction. If it falls 25%, it's considered a crash. Just technical terms, but that's what a crash is. And when the real estate crash happened in 2008, it was between 90 and 95% in some areas. Obviously, different assets, different subsets of an asset are going to see bigger crashes than others, but that's just kind of the way it works.
So with what's going on right now kind of in real estate and like stock market, crypto, as we kind of talked about, it's very, very volatile. What do you think is going to kind of come next as far as, a lot of people are buying right now. Stock market has hit a record this year in all the major indexes. As far as crash coming up, people are buying right now. Things are looking good.
Well, so you're saying what's going to happen? Is the market going to crash? What's going to cause it to crash?
Yeah, because mainly because we came off of a September that was so wild, at least for stocks. Now we're in October, things are kind of coming back at least a little bit. So, people are they're confused. They're not sure what to do.
Well, we're looking at day-to-day swings, which have nothing to do for investors. Investors are looking at the long term. What we're looking at is what's going on with the economy and what's going on with the dollar. Our economy is not growing fast enough. The Federal Reserve Bank and the government want to grow the economy. Good. But their opinions on how to grow the economy are different than my opinions on how to grow the economy. If you ask the Fed and the government, how do we grow the economy? They will say, stimulate.
Right.
Print more money and inject it into the economy. Yeah. Cool. You can grow the economy for the short term as long as people keep accepting the dollars, but you are hurting the majority of people.
Right.
You are making the majority of people poorer every time you print another dollar. What you need to do if you want to grow the economy is you need to promote innovation, creativity, and entrepreneurship. That's the only way that you can sustainably grow the economy. Now, in terms of risk factors, obviously our economy is not growing fast enough. Hopefully that gets picked up. We have supply chain issues across the world, which are affecting our country, which is really hurting us, which is slowing down the economy. We have issues with the dollar. That is a big concern for a lot of people who are studying money. It's when are people going to realize that this dollar that they're working for is just a piece of paper? And as more and more people start to see that the United States government is just printing more of this money and the dollar is losing value, well, you have countries around the world that are holding on to trillions of dollars. And if they start to lose faith in the dollar and they start to dump the dollar, that's going to be a real concern, because then people are going to run from the dollar. They're going to try to convert the dollar into something safer. Gold, cryptocurrency, real estate, companies, right? They're going to want something that's real, not something that's a piece of paper.
Right. So you're saying the next crash that could happen could be more than just the United States. It might be global.
We're in a global economy. The next time we see a crash, a real crash, is going to hurt because we have so many factors coming together. We have so much money printing that's already happened. We are at historically low interest rates. The Federal Reserve Bank cannot raise interest rates. They keep wanting to increase inflation. We have a national debt that is ballooning faster than ever. Our national debt is higher than our GDP. So what do we do? Well, get financially educated. You got to get financially educated. You need to know what to do with your money. You need to understand what the dollar is. You need to understand what's going on. That way you can use your money smartly. You don't want to panic. You do not want to panic. You just got to be educated. That way you can come out of whatever is coming a financial winner. Now, we don't know when the next crash is going to happen, if it's going to be 6 months or however many years from now, but you just have to be educated. That way you can make smart decisions with your money.
That way you can prepare.
Be prepared and come out of the next crash a winner, because more millionaires are made out of crashes and recessions than any other time. Does that answer your question?
Absolutely.
All right, another great guac talk.
If you didn't know, now you know.
Well, if you want to learn more, you have tons of videos on our channel. You can watch more of Nathan at Minority Mindset News. Check out his channel. We got daily financial and business updates every single day. Thank you for watching. If you enjoyed this video, here's a video on how the system keeps so many people poor that I think you'll love. And while you're at it, download our free guide on money management and investing. And as always, keep hustling. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm going to invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft?